Traders, welcome to Institutional Sunday. Brilliant episode for you today. December special. You can see the setup here. You can even see the PowerPoint slides here. The #1 fundamentals program on YouTube. In fact, not even #1, the only one, right? Where you're going to actually see stuff that drives the market and not hocus pocus nonsense. Hence the beat the retail nonsense sign behind me. We're about to get on with it. Today we've got last week's performance. By the way, hope you're enjoying the live trading videos that I've been putting out of me trading. Go and check those out after this, of course. But anyway, we're in December. Fascinating episode for you today. We're going to be talking about performance last week where the market rallied 3.5%. A lot of people asking me, why did it rally? Well, I'm going to bring you the reasons for that. Hint, nothing to do with random Fibonacci nonsense, right? There's some real reasons why the market was buoyant last week. We're going to talk about that. Things such as the Omicron positive news, inflation hitting, multi-decade highs. Important you understand why. Highest rate since 1982, and the market rallies 1%. So definitely something you should be on top of. And then just finally, most importantly, we're going to be talking about the FOMC next week, the last major economic data of the year. So really important you're aware of what to expect. Really going to be an important piece of news coming out next week. So without much further ado, let's get on with it. I'll see you on the other side. So last week, crazy week, right? Unsurprisingly, the buy the dip crowd straight in there as soon as early part of the week, we saw the positive COVID or Omicron related headlines coming through, and that really drove us towards what we saw last week, which was up 3.8% on the week, back to all-time highs on a closed basis. Unbelievable, guys, right? But I called it. I said last week the market's going to be supported this week as people realize the Omicron virus or its outcome is not as bad as initially thought, and we're going to talk about that today. But the point is 3.8% last week. What were the main drivers? Well, Monday, Tuesday was pretty much the bulk of that. You can see that there, up 3%. There was absolutely no economic data on Monday or Tuesday, but the market didn't just feel like rallying. Obviously, there was some impetus behind this, and that was the positive Omicron news. So we're going to focus on that today because obviously that's important and will continue to be important. And then finally on then Wednesday, Thursday, we didn't really do much, kind of flat. And then we ended up all-time highs close on Friday off the back of an absolutely atrocious CPI number and the equity market rally. So business as usual, right? So, but look, there's reasons why I think the market took that number, which was the highest since 1982, 6.8% on a headline basis, to be a positive, and that's what we're going to look at. So let's get into it. We're going to focus on the inflation and also on the Omicron. And just before we do that, let's just bring you the actual hard numbers, essentially, which was there. 0.8% headline month on month, which is 6.8% year on year, as I mentioned. Because the Omicron actually news came first before the inflation towards the end of the week, we're going to focus on that now. So let's have a look at that. So look, as always, I bring you the best charts, pictures in the business, and you can see that here. Around the last week of November, if you remember, it's when the WHO announced that Omicron was essentially classified as an official variant of concern, and the market collapsed, right? Also, we had Chairman Powell's comments that inflation is no longer transitory and they are talking about tapering more aggressively, and that obviously didn't help in terms of equity performance and all market performance. We saw obviously the markets coming off. Look where we are now, guys. Back to where we started. And essentially this rally is what you saw on the first picture here, this area here, right? Exactly that. So it's all been driven, coincided basically with the positive headline news coming out. You can see one headline I've put here. Pfizer made an announcement, right? That 3 doses, so the booster jab, essentially neutralizes the effect of Omicron. So even though, yes, the initial data suggested that it was highly transmissible and the rates of Omicron were accelerating, the actual effects or the symptoms are quite mild, or if anything, very similar to previous variants like the Delta. Also, hospitalizations are very, very low, right? Hospitalizations, and really the burden on healthcare systems hasn't really materialized, has it, so far? So you can see why everything really has been, I wouldn't necessarily say positive, but lack of negativity around this new Omicron virus. So the market realized that the initial panic was overdone, and I talked about this all last week. That's why you should watch Institutional Sundays. So hopefully that's given you a really good insight into why the market rallied so heavily off the back of some positivity finally around this Omicron picture. And we can see that here as well. If we look at global markets, the global picture, very important. You realize all of this news is not only driving equities, it's driving everything, right? Forex, commodities, you can see here, interest rate instruments, things like bonds, dollar, yen, and we can see that here. Everything in the last few days has risen, not as much as equities. Reasons for that, which we can discuss, but in general, all markets have been buoyed by this early part of the week. You can see that. Things like obviously crude oil are going to react positively to that, as global demand looks like it won't be as hit by weakness in the Omicron picture. So that's good for crude oil, and we can see that here. So that's the Omicron picture, all done and dusted. Hopefully that's given you a good insight into why the market rallied, despite the kind of initial negativity around it. Let's talk about inflation. Now you can see here, again, I keep saying it, best charts in the business, right? You can see inflation since 1982. Currently the 6.8 number I mentioned year on year headline, right? And I could have given you the breakdown, but I didn't want to go into too much detail. A lot of it is energy driven. So, this could be one of the highest readings. This could be the peak, fingers crossed, at or near the peak. So that could be why the market took this positively. But the reason I want to focus on inflation now is because that's what kind of ended up the end of the week, just giving us that little boost of 1% on Friday. We're going to discuss that. Why would the market take this favorably? Well, let's actually talk about the number first. So the number, as I've said many a time, was 6.8% year on year. It's the highest since 1982 over there. So for all intents and purposes, a pretty terrible number, right? At the face of it. Also, what does it tell us? It tells us that the Federal Reserve, FOMC, completely missed the mark with this comment about inflation being transitory. So Chairman Powell was right to say, dump this word, right? They've obviously got it wrong, very, very wrong on that. And it does open up, and this is the key point, it opens up the path, I think, to, and I hate to blow my own trumpet, if you go and watch all the Institutional Sundays, you will see I've been talking about the Fed are likely to increase the taper from 15 billion to maybe 30 billion. I've been talking about this for weeks because inflation has been, you can see it, it's been going up for weeks. Everyone knows that the Fed's mandate, which I'm going to talk about here and you'll see it, is a dual mandate, right? It's on inflation, right? And full unemployment, or maximizing employment. Right? If inflation is going up too much, they need to take action. It's common sense, right? So the taper that they initially announced, to me, always had to be increased, and I believe that's going to happen next week, and this opens up the path to that. It also raises question marks about maybe there being 3 interest rate hikes in 2022. Okay, so that's something for us to think about. And how does that impact markets? I've already said it before. It's nothing to panic about, because even in a tapering and the initial start of a rate hike cycle, equity markets generally shrug that off. It's towards the end of rate hike cycles where we might see some impact. So I don't see that being a big issue for the equity market, and we saw that the equity market didn't really react negatively to the increased chances of this taper occurring. So why did the market rally though? given, this number was very, very high, we might be getting a more hawkish FOMC next week. Everything would suggest that the market should sell off aggressively, right? And instead, we saw the market go to all-time highs. So why did we do that? Well, personally, I think it's down to 2 or 3 big factors. Number one is that I think the market is now probably feeling that inflation is near its peak. Why do I say that? Well, if you actually I haven't broken down the numbers here because I didn't want to overload you with data, but it's been driven essentially these high inflation rates. Yes, there's been some broad-based components, things like owner's equivalent rent, which I've talked about in the past, but ultimately this last bit of aggression has been predominantly driven by energy. And we've seen crude oil coming off recently, right? So I think the market is kind of hopeful that maybe we are at the peak now, right, in terms of inflation. If the Fed increases its taper, and the Fed has made it clear last week that they're going to now focus on inflation more than the labor market. So I think the market's thinking, okay, if the FOMC starts to take action from next week onwards and bring this taper forward, end of the tapering cycle, that will then start to have an impact on inflation. So I think the market's now always forward-looking, thinking, evidence suggests we may be at the peak. Number two is that I think there's a general kind of feeling that why has inflation risen? Well, it's been a byproduct, right, of positive GDP, right? A lot of this, it hasn't been necessarily artificially driven by supply. I guess there has been some supply side pressures, but it's also been demand, right? So a lot of heavy demand, positive GDP, and people obviously coming back with a surge, spending money, heavy demand. So it's a positive byproduct of actually a booming economy, and also it allows companies to raise prices, right? And we've seen that but in a positive way. So demand has increased, inflation has allowed companies to increase prices, increase profits, right? Which is being positive. It's like a circle being positive for GDP. So if you look at company growth rates, earnings growth, somewhere around 50%, I think, almost this year. A lot of that has been driven by price increases. It's allowed companies to increase their margins. These are all the positive components of inflation or impacts that inflation can have, and that's why I believe the market has shrugged it off and actually trying to look at the positive side of things, and the fact that they obviously, so you can see obviously the market going to all-time highs for those reasons, and the fact that the Fed will be acting quite aggressively. There are some other reasons. Let's be honest, the real Fed funds rate, if you deduct it for inflation, it's at the lowest in, I believe, around 40 years. So that is very, very supportive for equity markets, right? So obviously, this is on a real, not a nominal basis. When you account for inflation, the real Fed funds rate is so low at the moment. It's so supportive of equity markets. Here you can see earnings per share, which I just mentioned, grown 50%, record levels of earnings per share. So why wouldn't the equity market be rallying, in conjunction with obviously the reasons I mentioned about how they perceived high inflation to be? Well, that really leads us into next week. So hopefully that was a useful recap of last week and why the market's been so supported last week. Really time to think about now, just before we finish. Next week, FOMC, what to expect. I've been talking about this for weeks. This is such a crucial FOMC. It's going to be the last major data point of 2021. So absolutely crucial. So kind of what are we expecting next week, or what am I expecting? So it's going to be actually really fascinating, right? Because we've got what I think is going to be an announcement to increase the taper to 30 billion. What impact do I think that will have on the markets? I don't think it's going to be negative, even though theoretically in an economic textbook you would think this would be negative. It's not. Like I said before, the underlying supportive factors of the markets are still very strong. Companies are making a lot of money. GDP's hearing numbers of like 7%, 8% for the last quarter on an annualized basis. Completely crazy numbers. And in fact, we're going to get updated economics forecasts. What will be interesting is this updated dot plot, right? So this is going to tell us what the FOMC committee individually, where they forecast interest rates to be in 22, 23, 24, so on and so forth. So that'll be very interesting. If they start getting very hawkish and start tilting towards 3 to 4 rate hikes next year, what that's likely to do, I don't think it's going to have a majorly negative impact, because the market probably does want the Fed to start to deal with this inflation number. So rate hikes are to be expected at some stage, of course, obviously with an increased taper. But it will likely bring some volatility, and we'll also see with the Q&A next week. We're going to hear Powell's thoughts, on inflation. What are his thoughts on inflation going into next year? Now we've got this latest CPI number. We want to know what he has to say. What are his thoughts on, I've put here COVID, but actually Omicron, how are they going to be dealing with that? So those are going to be really, really interesting. I think given what's happened this week, I don't see the market reacting negatively to that. Let's be honest, we're at all-time highs, all-time high close. There's no reason to be bearish on the market at all. I think that's a fool's game to do that. Just go with it at the moment. Just finally, keep saying it, literally bringing you the best charts, right, for free. It's unbelievable. So history suggests some volatility next week, right? This is a 25-year average of where markets have been. If you look at this period in general, we've had a lot of volatility before we get the Santa Claus rally, right? I mean, we've already had 3% rally this month. We're up, I believe, a couple of percent this month and 3% last week, because we were down 1% the week before, weren't we? So about 2% for the month. History suggests some volatility here, unsurprising with the FOMC, and obviously, so that's what I do think we will get, some volatility. And then after we go past that, I think everyone will be front running each other to get on the back of potentially a fairly decent climb up in the S&P going into kind of the end of year. And just finally, to wrap up, a nice way to wrap up, we can just have a look at the data calendar. We can see retail sales on Wednesday, expected to be positive, no surprise, given the holiday season and obviously people spending money on each other, right? 'Tis the season to be jolly and all of that. This is going to be the focus, obviously, for me. So it happens on the same day as retail sales, so I actually think this will take more focus away from that. So that's really where the focus is going to be. Click the link to subscribe. Hopefully you enjoyed that. If you have any questions, let me know. Please leave some comments below. Like and subscribe, all the usual stuff. Have a great New Year, Christmas. I'll see you next week.